India is a fast-growing economy with a huge potential for trade and investment. However, it also faces some challenges in its external sector, such as a persistent trade deficit, a volatile exchange rate, and a dependence on oil imports. To overcome these challenges and boost its Forex reserves, India is pursuing free trade agreements, FTAs, with various countries and trade blocs. These FTAs will help India increase its exports of goods and services, especially in sectors where it has a comparative advantage, and reduce its trade deficit. According to Commerce and Industry Minister Piyush Goyal, India's Forex reserves are comfortable for the next 5 to 6 years, even in the worst-case scenario. He said that India's FTAs will help generate surpluses and keep a strong economy. He also expressed confidence that India will achieve the target of $1 trillion each of goods and services exports by 2030. Some of the FTAs that India is negotiating or exploring are with the UK, Canada, European Union, EFTA, Switzerland, Norway, Liechtenstein and Iceland, Australia, New Zealand, and the Gulf Cooperation Council. These FTAs will give India access to large and lucrative markets, where it can export its products and services at competitive prices. Some of the sectors where India has a comparative advantage are textiles, gems and jewelry, pharmaceuticals, IT and IT-enabled services, engineering goods, agriculture and allied products. By increasing its exports through FTAs, India will be able to reduce its trade deficit, which was a record $266.78 billion in FY. A lower trade deficit will improve India's current account balance and reduce its vulnerability to external shocks. It will also help India save on foreign exchange outflows and accumulate more Forex reserves. Forex reserves are important for maintaining macroeconomic stability, meeting import payments, servicing external debt, and intervening in the currency market to prevent excessive volatility. Therefore, India's FTAs with various countries and trade blocs will help increase its exports of goods and services, especially in sectors where it has a comparative advantage, and reduce its trade deficit. This will in turn boost its Forex reserves for the next 5 to 6 years and strengthen its economic position in the global arena. India's FTAs will enable it to diversify its markets and reduce its dependence on oil imports, which will have a positive impact on its foreign exchange reserves and current account balance. India is currently negotiating FTAs with several countries and regions, such as the UK, Canada, the EU and EFTA. These FTAs will help India access new and larger markets for its goods and services, especially in sectors where it has a competitive edge, such as textiles, pharmaceuticals, IT and engineering. By expanding its export basket, India will be able to generate more foreign exchange earnings and reduce its trade deficit. At the same time, India's FTAs will also help it lower its import bill, especially for oil, which is one of the major items in its import basket. Oil imports account for about 25% of India's total imports and have a significant impact on its current account balance and Forex reserves. By signing FTAs with oil-producing countries or regions, such as the GCC, Gulf Cooperation Council, India will be able to secure preferential tariffs and stable supplies of oil, which will reduce its vulnerability to oil price fluctuations and supply shocks. Moreover, India's FTAs will also help it diversify its sources of oil imports and reduce its dependence on a few countries, such as Saudi Arabia and Iraq, which together account for more than 40% of India's oil imports. By importing oil from a wider range of countries or regions, such as the US, Russia, Africa, and Latin America, India will be able to hedge against geopolitical risks and enhance its energy security. By reducing its dependence on oil imports and increasing its export earnings, India will be able to improve its current account balance and Forex reserves. A positive current account balance means that India's foreign exchange inflows exceed its outflows, which adds to its forex reserves. A high level of forex reserves provides a cushion against external shocks and helps maintain the stability of the rupee. According to Commerce and Industry Minister Piyush Goyal, India's forex reserves are comfortable for the next 5 to 6 years, and the FTAs will help generate surpluses in the years to come. He also said that India's export basket has all the things that the world desires, and that oil prices will have a downward trend in the future. Therefore, India's FTAs will enable it to diversify its markets and reduce its dependence on oil imports, which will have a positive impact on its foreign exchange reserves and current account balance.